Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night. We have been doing this every Tuesday night, Zoom at 8, for almost 6 years. I cannot believe it. You guys have dedicated your Tuesday nights to building relationships, learning and networking with industry experts in this live conversation. You get in the door, we build relationships, and you know what? It is your oyster. This is who you can make and where you can build the relationships that really create a strong future. So I'm here every Tuesday night. And you know what? I am a lender and hope to be the lender of choice. I work with Old Capital Lending, and we are multifamily specialists, but we don't just stop there. We do other asset classes as well. So if you are looking at a deal and you're looking for how do I underwrite this? You can reach out to me and I'd love to have that opportunity. I'm going to ask you to, before you put in an LOI, come reach out. I'm going to look at your T12 rent roll, your underwriting, and a OM, and we're going to take a look at it. It'll take me about 48 hours to run it on agency. Now, agency is your gold standard of lending, but you need to know if it is over 90% occupied, it's a win. If it is over 1 million in loan proceeds, it's a win. But if it's less than $1 million, we can take a look at it, but it's going to be a bank loan. All right. And there's struggles with the bank lending, but we can take a look at it for you. I'm not just a lender, though. I capital raise, I sponsor, I find sponsors, I find investors. So I'm a little different than what you might think of. I'm excited tonight because we have Jim Ross. Now, I have not known Jim Ross more than about 4 days, just kidding. But Jim Ross, I saw him at a recent meeting that I went to, and I said, that guy is impressive. Anybody know who Robert Kiyosaki is other than Paula? Who knows who Robert Kiyosaki is? Most everybody has heard that name. Yeah, thank you, Kenneth. Tom Wheelwright started ProVision. How many years ago, Jim?
I want to say it's about 30 years ago.
30 years ago. Well, Tom Wheelwright is Robert Kiyosaki's CPA, started ProVision, and set up a bunch. It was brought in some partners, and he has since stepped out of the business. And there's 6 partners in the ProVision company. And so Jim Ross has helped many investors like yourself to achieve better tax efficiency through entity structuring, maximizing deductions, utilizing tax elections, and specializing in designation, special designation, and various tax advantaged investing strategies. So you want to know Jim Ross. He at ProVision, along with the total of 6 investors that own it. He also prepares taxes for small businesses and their owners, including many multifamily real estate partnerships like all of us have or are building. So he's going to have some real tips for your success. He's also an avid baker, and he does that when he can squeeze it in, probably not around April 15th. And he has successfully baked many fun and technically challenging pastries and other treats that he shares with his friends, family, and coworkers. Boy, oh boy, are you working out of an office? I need to know the address so I can fly on by. Anyway, Jim Ross is out of Phoenix. So if you're in the Phoenix area, you need to reach out to Jim Ross. We welcome him here to Zoom at 8. So Jim, welcome.
Thank
Glad you're
you.
here. Thank
Yeah,
you
and
so
by the way,
much.
you don't have to be in Phoenix to reach out. Like we do these Zoom meetings with our clients all over the country. And so, if you're in Georgia or whatever, like we can talk.
That is a good point. Now, let's make sure that we are giving all of our attention to Jim or myself. You go up to the right-hand side of your screen and go to speaker view. You should see me. Lovely me. And again, before we get started, make sure that you are putting your information in the chat. And if you need to leave, I'm very sad, but make sure you take it with you. If you open up the chat, there's three little dots, probably at the top. Click on that. It'll say save chat. You only need to do it once. Okay. So Jim Ross, tax strategies, CPA, Baker. Let's start out with Baker because I think that's the most fun. So, and sometimes we think of CPAs not being all that much of a personality. And I think you break that trend. I think you're different than most CPAs. So let's talk about what's most fun is the baking. What do you like to do? Do you have to measure it? Like to me,
Yeah.
I'm not surprised because numbers are black and white, on or off, right? And so baking, you have to be precise.
If you can
So
follow some instructions and use procedures and measure and yeah, that's it kind of gravitated naturally into that. Any of you watch the show The Great British Baking Show?
I
Anyone?
have
Yeah,
seen it.
handful.
Yeah.
Yep, great show.
Yeah.
You can watch them on Netflix. I would see those guys making these incredible pastries and elaborate things, and I thought, I think that would be really cool to try and make some of these things. And good friend of mine recommended a book called The Art of French Pastry, and it's written by a Frenchman who's kind of actually ran a school in Chicago for many years, and it's almost like a textbook for baking pastries. And so you want to learn how to make macarons, and it goes into depth about what kinds of tools to use and the best kinds of ingredients and the processes and the procedures. And some of the recipes are 5 and 6 pages long of that kind of detail. So yeah, I've made all sorts of fun things: macarons, eclairs, croissants, um, creme brulee. I've made lots of different kinds of breads like sourdough. I got really into sourdough for a while there. Be warned, if you start making sourdough, you won't stop for like a year. You'll just really get
Yeah.
stuck in it.
Yeah. That is true. That is true. It's kind of like kombucha.
Yeah, yeah, yeah. It's kind of addicting, and then you always want to like tweak it, and you're like, I can do a little bit better. And then it's every week you're churning out all these loaves, and then your wife goes, "What happened to all the like fun sweets that you were making? You've just been making bread all the time." Um, but yeah, it's fun. I like doing it, and I gave the analogy when Julianne and I were in New York City, and I was talking to the group about making your tax return is like baking a cake, and you need the right tools and you need the right ingredients and you need to follow the right process. It takes expertise, it takes practice. And so if you don't have to be a baker, not everyone is gonna be their own tax expert, but hire a good baker and you'll have a delicious treat at the end, and it'll be worth it.
I love it. All right. So tax strategies. We talk about strategies being done at the end of the year. We bring in a tax strategist most times in the end of the year here at Zoom at 8. I think it's most important to know where you're going. So we can always
Absolutely.
talk about, hey, what did I do in 2024 that I want to change in 25? So I think bringing you on here early in the year so that we are very clear what are some of the things we need to be really focusing on, whether it's our business, our multifamily business, whether it's our home, how do we do our write-offs on our home if we're working out of our home, thinking about other um, asset classes that may be advantageous to us to be looking at. Maybe looking at some Roth IRAs. Maybe the stock market is. There's a lot of diversification, and knowing what the right strategy is for each of us is so important. So, as we kind of outline today's conversation, this is going to be a general conversation because everybody has a different situation, right? So, if you guys need further information, I highly recommend you reach out to Jim Ross, but he's going to give us a general overview of how these tax strategies as a whole can help us. So, Jim, let's talk about strategies in multifamily.
Yeah, I love talking about real estate in particular. I think, even before you start getting into the tax benefits of investing in real estate, as just an investment tool, as just a component of your wealth creation, it's such a powerful asset class. And we talk about real estate as having, like four legs of a bar stool. And you have the cash flow and the appreciation and the mortgage buy down, and you have the tax savings. And if you consider all of those components together as part of your overall rate of return on the investment, and a lot of people miss that tax benefit and the value of that as part of your rate of return. It can really supercharge how much money you're making in your investing. And so you might have, think about like stocks, for example. You invest in some Apple stock, and if it does really well, the stock goes up. But if you want to cash that out, guess what? You're going to pay tax on the capital gain. You may also have in your portfolio of investments some dividend income, some interest income, and that's all stuff that you're going to also pay tax on. And you'd be lucky. I mean, I think most people would be pretty content if their portfolio did what, 12, 14, 15% rate of return. If you're very heavily invested in S&P 500, you might have, relatively high rates of return there, but that's pre-tax. So factor tax into that, and then you're going to come away with, probably 60 cents on the dollar of that increase that you just got. Compare that now to real estate, where very often, in fact, most of the time, you invest in real estate, and it doesn't have to be multifamily, it could be single family, it could be anywhere in between. And you can almost always create a scenario where that segment of your wealth, the real estate segment, is growing tax free. Of course, everyone wants cash flow, right? Cash flow is king. Everyone's talking about cash flow. And if it cash flows, that's great. I love the idea of building a portfolio of passive cash flowing assets. And everyone wants to get out of the rat race. That's another Robert Kiyosaki term. The great game Cash Flow. If you haven't played that game, it's really fun. But that's what it's all about. It's creating sources of passive income so that eventually you can leave the W-2 job. You can depart from the grind of the 9 to 5 and then live on the passive cash flow and be a full-time investor. And real estate absolutely can provide that. Now, the reason real estate provides that tax-free component to your wealth creation is because you can create paper losses that are not real losses. Okay, so when you report on your taxes the activity of rental real estate, okay, everyone's like, well, how much is my depreciation? Well, that's great, but that's a deduction. All right, you can have rental income at the top. All right, and then you're going to list out all the expenses of that property: repairs and maintenance, management, interest, insurance, utilities, HOA. You're going to have all the expenses of carrying that property are deductions. Depreciation is just one of them. Okay, so when you expense off all those things and you get to the bottom, it may say that you have a $20,000 tax loss on paper, let's just say. That doesn't mean that you lost $20,000 on this property. It may just mean that you're accelerating deductions into now, using depreciation as one of them, for example. And very often you can show cash flow versus tax. You can say, this is what my asset's actually doing. It's going up in value. The loan is going down in value. I have cash flow coming in. Okay. And that's what lenders want to see, right? Is the property performing? Is it producing a rate of return? And is it going to be, am I going to have money when I go to sell this thing? But at the same time that you're doing that, you may show a tax loss. And by the way, it's pretty well accepted within the lender realm, as far as I've seen, that depreciation is an add back, okay, because it's a non-cash item. So you have this great paper loss from depreciation, but when you go to get financing, if you want to refinance or whatever it may be, that depreciation is not really counting against you as saying that you're losing money on this thing. Is that right, Julianne?
That's correct. That is correct. Right.
Okay.
So you're talking about cash flow, and not a lot of us are getting cash flow right now. So when we think about these tax strategies and we're not getting tax, any cash flow, is that hurting us from a tax perspective this year? I would say probably not with these K1s coming on. I'm not getting any those deductions. I don't have to pay against the cash that I brought in.
Yeah.
Talk to us a little bit about that, because I know in the past we've had recapture, and that's been costly for us in multifamily. How is it going to be when some of these are coming up, we took the K1 losses, right? Because at the beginning on the cost segregation, now maybe 2-3 years later, as a investor, we're maybe going to sell at a loss. Are we going to have recapture on that asset that we've
I,
lost?
mhm.
And what can we do to offset that?
Yeah, that's a
Ooh.
great question. So the hardest part about conceptualizing the tax gain or loss on the sale of a property is that it's more complicated than just saying I paid X to buy it and I'm selling it for Y and I either have a gain or a loss there. Okay. Think about your basis. Okay. This is a term that we talk about a lot in tax, and it has, it kind of permeates throughout other categories of investments too. And I'll start with kind of a basic analogy back to the stock comparison. If I buy a stock today and the stock costs $1,000 on today's value, later when I sell that stock, that's what I'm going to compare, right? Did I sell it later for more or less than $1,000? Okay. And if it's more, I have a gain. If it's less, I have a loss. And that's what's going to hit my taxes. Now, jump over to the real estate side of things. You buy the property, you get the cost segregation study. Okay. And it gives you this great big tax deduction in year one. Now, what has that done to my basis? That has pulled my basis down. So the relevant question when I look at the gain or loss at the end when I've sold it isn't what did I pay for it? It's what did I pay for it less all the depreciation that I've taken. Okay, now what is that going to do? It's going to mean that it looks like I have a bigger gain. Okay. And so that's where you have to do some analysis and say, all right, if I paid $500,000 for the property, okay, and I've deducted $200,000 worth of depreciation on it. So I started at 500. Now I've pulled my basis down to 300. Okay. Where am I going to sell it? Maybe I sell it somewhere in the middle. Maybe if like in your scenario, maybe I sold it at a loss because I just needed to offload it and get what I could out of it. Okay. And I sold it for 450. Well, you might think I paid 500. I'm selling for 450. I've got a loss, but where's my basis? It's over here. It's 300. So I may have a $150,000 gain there because of recapture. It's because that deduction that I took earlier has pulled my basis in the asset down. And when I sell that thing later, that's where I've got to look to make that comparison. See, do I have a gain or a loss? Now, let's suppose you have the gain because of recapture. You've lowered your basis so much, and now you've got some gain on the sale. What you want to look at is, can I, in the same tax year, create additional losses from something else, right? If you're going to sell an asset and now you have proceeds from a sale, hopefully you can go out and reinvest and get another deal going. Or maybe you already have some other deals kind of in the works, right? I know a lot of my clients, investors, before they're even selling something, they're kind of already looking down the pipeline and saying, what else, what am I going to do next here? Are there deals that are in the pipeline that I can now invest into? If I create new losses from another deal, that can offset this gain over here from the sale of the property that I just had. And so you can offset one property's income components against another. And if you time that in the same tax year, that is helpful. Now you can't always, have your cake and eat it too. I try to tell people if there's any wiggle room, try and sell your property in Q1. Why sell in Q1? Well, then you have the whole rest of the year to figure out what your taxes are going to do and to make those reinvestments. Okay, so that's one thing to keep in mind. The other thing I like to remind people of, okay, let's say you are I've got clients that have 50, 60, 80 K1s. Okay, they're serial syndication investors. Okay, hundreds in some cases. Very often, because they've bought so many deals over the past few years, they haven't been able to use all of those losses that they got. Imagine if you had, like 20 K1s in 1 year on new properties that all did cost segregation studies. Well, they got to use losses to knock out all the tax from all their income from those years. But if they didn't use all the losses at that point, well, where did they go? They carried over. They carried over and they carried over. So that's another thing to look at. If you think you might have a gain coming down the pipeline from a sale event, let's look at your taxes. There are schedules in your taxes that tell you how much of these losses you've been carrying. And you may have some. You may have what are called passive activity losses. That's where if you are a passive investor, say you're not a sponsor, Okay. You're just an LP and they're, attributing losses to you. And you may not be able to use those losses if you're not an active real estate investor. You may have suspended passive losses. Well, you're going to get to use those later when the gains come.
You know, that is so much information there. I want to go back to the passive losses because there's a lot of folks here that are trying to become full-time investors. They have a
Sure.
W-2 and maybe their wife is at home taking care of the children. Can we walk through how we may have a checkbox on your taxes that says, oh, my wife is a real estate professional,
Sure.
and how this might help for those passive losses to become active losses? Walk us through that. And that's a great strategy.
Yeah, absolutely. The trick there is in the category of rental real estate, and it doesn't matter whether it's a single family home or 200 unit complex. Okay. That's rental real estate. And in order to take one of those paper losses we were talking about and deduct it this year, you have to have either other sources of passive income that are going to offset. You can offset within the category of passive income from one deal, passive loss from another. Those can offset, and I can use the deduction of one against the other. But if you don't have that situation, then the question is, am I a real estate professional? Okay. If I'm a real estate professional, I can use that loss, that paper loss, regardless of whatever else is on my taxes. So I could use it against potentially wages income, interest income, dividends income, capital gains income, um, unemployment income, social security income. Okay. There's all the different kinds of income. It doesn't matter. If you're a real estate professional, that loss is going to be allowed to be deducted against whatever source of income that you have. Now, the challenge is to say that you're a real estate professional, you have to log your time. Okay, the CPA is always going to tell you to log your time. I know a lot of you aren't going to do it, but log your time. Okay, how much time are you spending on real estate? All right, and keep a log of on this day I did this many hours of whatever I was doing. Number two, did you spend on the year 750 hours? Okay. Now, a full time job is seen to be 2,080 hours. So 750 is not a full time job. It's less than half a job, but it's not nothing. It still takes some time to be a real estate professional. Okay. So 750 hours on the year, and that's in aggregate. You can have a bunch of different real estate activities that you're involved in. Look at it in aggregate, and 750 is what you're shooting for. And then number three, you need to spend more time on real estate in total than non-real estate. You can have other stuff going on, but the real estate stuff has to be more. And that's where it's tricky, because if you work a full-time job and you work 40 hours a week and you only do 10 hours a week on real estate, it's not going to work. You're not going to be a real estate professional. But to Julie's point, if you're married, you can have a scenario where one spouse is W-2 employee and the other spouse is a real estate professional, and say, hey, honey, listen, this strategy is going to save us $40,000 on our taxes. Can you do it and work together? And you can absolutely make that happen. So if you file a married filing joint tax return and one spouse is a real estate professional, the other spouse can be whatever. They can be an employee, etc. And the losses from real estate can be used in full to lower the taxes from all those other sources of income. Make
Amazing.
sense?
Yeah, I mean, this is huge information. If you don't know that, can we talk a little bit about when we talk about how much time in real estate? Because I am a mortgage broker, but I spend a ton of time capital raising, educating, looking at my assets, talking about assets. I had a CPA that said, you're not a real estate professional. But I spend 51 of my hours of the week, of the day, talking about real estate.
Yeah.
He would not do my taxes. He said, you need to go away if you think you're a real estate professional. I said, okay, I'm out. I am a real estate professional. So I want to hear your thoughts on when you say real estate.
Yeah.
Can
what
I
what time
drive?
is real estate time? Yeah,
Yeah.
I'm with you. So the component of the tax law that we're talking about that allows for this treatment is section 469. Okay. And there are specific words in that section. They're pretty high level. Okay. It's not, there's the words are specific, but you can kind of attribute them to mean different things. So there's not a lot of them. I'll just kind of hash over them real quick. Development, redevelopment. Okay. If you develop property or redevelop property, those are real estate activities. Acquisition or conversion. If you're buying property or converting property, right? Rental. If you own and rent property, that's real estate time. Management or operation. I manage or I operate. Leasing. I don't know what, between leasing and rental, it's kind of the same. Brokerage. Real estate brokerage. Now, is capital lending brokerage, maybe a little different from real estate brokerage? I would say that it is. So those are the terms that are specifically in the tax law. And I caution people a little bit, okay, where I see people try and stretch the definition here is in a couple of areas. One, the educational area, right? They spend tons of time, listening to podcasts and reading books and going to conferences and et cetera.
Yeah.
None of that matches up with the words that are in 469. Okay. Am I going to say don't track it? I would say put it on your log. Okay. But you better have more than 750 at that point. Maybe your log says you have 850 and some of them are educational hours. The other one is people that are just on the hunt, right? They're looking at deals and looking at deals and looking at deals, and they're scouring Zillow and they're talking, it's all the time that you spend looking for deals. I would urge you to not have a large portion of your real estate hours come from that. Okay. Now, at the point that you pick a deal and you go down that road and you say, I'm going after this deal and I'm now spending time, I'm doing due diligence, I'm getting, offers ready, et cetera. I would say all that time counts. Okay. But just scouring for hours at a time and all this stuff that you didn't spend any time on, really, I probably wouldn't put a lot of that time on my log. Okay.
So underwriting?
Underwriting, yeah, because
Perfect.
they're one of those words, and to me is somewhat broad, is acquisition. Well, what is acquisition time? From the point that you decide that you're going after a property, it's all the time you spend dealing with it, right?
Okay.
Including underwriting, which is a lot of time. People spend a lot of time in that phase, and there's a lot of paperwork and a lot of back and forth communication, and yeah, it's a lot.
So we have Melissa and we have John Hawkins in our audience. They are both full-time employees and they work day and night trying to underwrite, look at deals, go visit. They're not real estate professionals at this point in their, if you look at it, okay? Because I think a lot of CPAs, tax strategists would say, you're a W-2, we can't really use that real estate professional, right? What do they do with those? Like, how can they utilize that not as a real estate professional? All
Yeah,
these hours, that's important.
it's tricky. It's very hard, and it's countless people that I've spoken to that just can't make the criteria work yet. Maybe they will over time, as they build up the portfolio and maybe they start to take time away from the other stuff that's making them not real estate professionals. Maybe they go to 35 hours and then 30 hours and build, add another property. The pendulum starts to swing and then they become a real estate professional at one point. But there are some things that you do in the interim. I mean, we talked a little bit about the planning of the gains and losses thing. There's planning and analysis to be done. If you know that a deal is that you're passive in is going to close and you're going to have a gain, it's planning out what to do with that. Do I have enough carried suspended losses that I haven't used yet to negate the tax on this gain? Or am I going to look to buy another investment that's going to produce new losses and offset? The other thing that they might look at, I really like the asset type of short-term rentals. Okay. Because
Right.
short-term rentals is kind of like a loophole, if you will, if certain criteria are met, right? We talked a little bit back about how, rental real estate is passive, and you have to be a real estate professional to treat those losses as non-passive, right? That's
Or
sort of like
active.
as active. Yeah, it's sort of
Okay.
like the default is passive, but you can make it active if you're a real estate professional. Okay,
Got it.
but what's even rental? Is a hotel rental? It's not. If I own and operate a hotel, that is not a rental property. That is just an ordinary business.
Business.
Now, on the sliding scale, where on one end is a long-term rental and on the other end is a hotel, where does a short-term rental fall? All right. And it can fall anywhere on that spectrum. And it has to do with the average number of days that people stay there. And it has to do with the level of services that are provided. Now, if you basically what the law says, if you have a short-term rental and if the average stay of your guests on the year is 7 days or less, okay, and that's very often the case. You might have some that are 10 or 15 days. You might have some that are 2 or 3 days, but you average it over the course of the year. If the average stay is 7 days or less, then that is not rental real estate. So you don't even have to ask the question of, can I be a real estate professional? You have different questions to ask. Okay, so you set aside real estate professional because you don't have a rental property, you have a business, and then you have to ask the question, do I have material participation? All right, and those thresholds are easier to meet than the real estate professional ones. So what's material participation? Um, do you work 500 or more hours during the year in the activity? Not 750, 500. Okay, that's one. Number two, do you do substantially all the work in the activity? Right? If I'm doing it myself, I've met that criteria. I have material participation. Number three, do I work more than 100 hours in the activity during the year and no one else does more? Maybe there's two people. Okay, I do at least 100 hours, but I do more than anyone else. I've met that one. Do you participate on a regular, continuous, and substantial basis during the year and more than 100 hours? Now, those criteria that I just listed out, you don't have to hit all those criteria. You have to hit any one of them, any one of them. Okay. So if you participate on a short-term rental on a regular, continuous, and substantial basis and at least 100 hours during the year, you are able to treat that as a non-passive activity, as an active business. Okay. Then you don't have limitations on how much of a loss you can deduct on that property. You can get a cost segregation study. You can deduct the loss against your wage income. You don't have to spend more time on real estate than your non-real estate stuff. So I have W-2 clients who work 40 hours plus in a week and who do short-term rentals on the side, and they are allowed to deduct those losses.
I love this. And you can have just one of those, right?
Yeah.
Guys, listen up. Hunter, we're talking about you. You are a broker. Yes, you can use that, you're a real estate professional. But if you're a W-2 earner, Melissa, W-2 earner, well, your husband is real estate in real estate. So you two, it doesn't necessarily mean. Sanjay, your wife works, you work, you want passive, be active. You have one Airbnb short-term rental, and now you get those active losses. Is that right? You call it active losses at that point? Is that what you
What
would
we
call it?
what we call it is non-passive. But yeah, that's
Non-passive. I
that's
like
essentially
active.
it's the same thing. It's the same thing. Yeah.
So I think we forget about that. That's a great strategy. I think I'm so glad you talked about that. Let's talk about Roth IRA tax strategy. There's a maximum amount of how much you can invest in your 401k, your IRA, right?
Yep.
And as you get older, 55, 63, I think it goes up. This Roth IRA may be another tax strategy for you that can be helpful. So can we talk about Roth IRA before it's going to be after tax investments?
Yeah, I love the Roth IRA because you kind of have to ask the question of, income is probably going to hit my tax return at some point or another. And if it does, what tax rate is going to apply? And when is it best for that to hit my tax return? If it hits my tax return today, maybe I know what my tax rate is.
Mm.
If it hits my tax return 20 years from now, what is Congress going to do to the tax rates? Are the tax rates going to go up? Am I going to pay tax on all that growth? When does it make the most sense for me to report that income? Now, a Roth is a scenario where the income stays on my tax return now, but at least I know what the rate is. And if I'm young, especially, right? And I think my income is going to do this over the course of time. It's going to go up slowly over time. And if you're a serial entrepreneur investor, that may continue to be the case even after you've retired. Okay. In the world I operate in, my clients are all entrepreneurs, investors. They're never done playing the game, which means their income just keeps going up, even when they leave the W-2 job. So that myth that, kick the can down the road with deferral, like defer as much money into your 401k because you'll pay the tax on it later. Well, you're going to pay tax on it later. If your income keeps going up, you may pay tax at a higher rate. If tax rates go up, you may pay tax at a higher rate. And you're going to pay tax on all that growth too, way down the road when you start pulling money out of your retirement accounts. Whereas you put stuff in your Roth and it grows tax free, okay, forever. And you growth upon growth upon growth upon growth. Imagine 20, 30, 40 years from now, what that value becomes, and you paid tax on this much and now it's worth this much, and you're never going to pay tax on all that growth. So that's the benefit of Roth. What's tricky about Roth is a lot of folks cannot contribute to a Roth because their income's too high. And so you have what's called a backdoor Roth, okay, which is essentially where you make what's called a non-deductible contribution to a traditional IRA. So you can put, for example, $7,000 into an IRA, traditional IRA. If you're not allowed to deduct that because your income's too high, you have a non-deductible IRA contribution. You then do a conversion of that into a Roth IRA. And that is a way of essentially skirting the limitation that says, hey, man, your income's too high. You cannot put money into a Roth IRA. You can get around that. So if that's not something that you've looked at, talk with your CPA about it. The question is, here's what drives me nuts. Okay, out there in the world, there is a one-size-fits-all type of strategy, which is you work your job, you put as much money into your 401k as possible, and you park it in, one of 2 or 3 different mutual funds that they offer with the program. And that's basically it. And everyone's doing the same thing. Well, when does it make sense for you to report that income? It might be different from one person to the next, and it is. And you should look at your plans and your timeline with your CPA and figure that out. I have this gal out in Florida. She's in her mid 70s. She sells more properties than anyone in Florida. She's like a firecracker at her age, but she is thinking like in the near future, I'm retiring. Okay. And in her case is, I'm going to sock as much money into retirement accounts as I can, because then I'm going to quit. All the income that's putting me in high tax brackets now is going to stop. It's like shutting off the fire hose. Okay. And then the only income she's going to have next year and the year after that is however much she pulls out of the retirement accounts, which is going to be at lower tax rates. Very high tax brackets now because she makes a lot of money. But after she retires, her income is going to be like this. It's going to be lower. Okay. So she's trying to defer tax, push as much money into later tax years as possible. But if you're on the other side of it and you're thinking, well, I'm young and I've got, a long career of saving and investing ahead of me, and my income is just going to be going up, 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 up forever, then it may be better for you to not defer that tax, put money into a Roth, let it grow tax-free that way. While we're on that, if you have kids, this is my favorite tax strategy out of all the tax strategies we do. If you have kids and you have a business, put your kids on the payroll. Okay. You can pay them up to the standard deduction out of your business as an employee. If they get less than the standard deduction, which I think in 25 is up to $15,000. So if your kid makes less than $15,000 of wages out of your business, then that is income coming out of your higher tax brackets. It's going into their bracket at 0%. They're not going to pay any tax on that $15,000. In fact, they don't even have to file. If their total earned income is less than the standard deduction, they don't have to file a tax return. Okay. Now let's sweeten that deal. Back to the Roth. Now your kid, maybe your kid's 12 years old, and you have rental real estate. You take them down there, you have them help you do a clean out, a trash out, turn over a unit or do some landscaping work or whatever it is. Maybe you have them do some office administration or some data entry type stuff. Okay. So you pay your kid. Now they have earnings. They have earned income, which means they can contribute to an IRA, including a Roth IRA. Now, normally, if I put money into a Roth, what went into the Roth has been tax, right? I didn't take a deduction today. Okay. I'm letting that income be taxed, and then it goes into the Roth post-tax. Money in the Roth has already been taxed. But if your kid gets earnings and they're below the standard deduction, that money is taxed. It's just taxed at 0%. Okay. So now they've put money into a Roth that is taxed. They didn't pay any tax because it was at 0%. And that money will grow tax free in the Roth. Okay. So it never got taxed. So that's like a double whammy. You've pulled income out of your high tax brackets, you've put it into a 0%. They invested in a Roth, tax-free growth to the kid. People talk about 529 college savings and plans. It's nothing compared to this strategy. If you have a business, and I'll sweeten the deal with one more thing there. If your business is a partnership or a sole proprietorship, okay, a non-corporate type of entity, this does not apply for S corps or C corps. Okay, if you have a non-corporate type of entity, it's usually sole props and partnerships. And if you pay a minor out of your business, a family-owned business, you pay your son who's only 15 years old, their wages are not subject to FICA tax. So you don't even have to withhold anything. Okay, they have no income tax, and you don't have to take out Social Security and Medicare. So that can be applicable, and sometimes you can do some planning around that. If you come to me and say, "Hey Jim, well my only company is an S corp, how do I do that?" There's a way. We'll talk through it. We'll figure it out. Julianne, how are we doing? You're on mute.
I'm glad somebody's in charge here. Okay. There's tons of questions in here, and I think we could go on for another hour, 2 hours on more of these tax strategies. That last one, it is amazing. So let's kind of pull up some of these questions and see if we can get a clear answer from you before we do some breakouts here. So can you talk about K1s from an SD IRA versus a K1 from your company outside of the IRA?
Where the IRA holds the interest in the investment?
Correct.
Yeah. So you have a self-directed IRA. You find a multifamily deal that you like. You plunk down your $100,000 or whatever it is. Okay. And then at tax time, the syndication files its partnership tax return. It issues a K1 to all of its investors, including to your self-directed IRA. And that can be fine, and very often is. Remember, we talked about how in that category of passive, you may have a bunch of these K1 activities, and you can kind of offset stuff one against the other. You may have income from one and loss from another, or you may have, overall just losses that you're carrying. And that's not really an issue with self-directed IRAs. But where you can have an issue is if the income is positive. Okay, overall, you look at all the sources of income that are flowing into that self-directed IRA, and if you have a positive amount of income, taxable income, I'm not talking about cash flow. Remember, we're talking about what does the paper on your taxes show? Okay, is it positive or negative? You can run into what's called UBIT tax.
That's only on a self-directed, not a 401 solo 401k.
That's correct. That's correct, because those two types of accounts fall into different sections of the tax law. So an IRA has different rules from a 401k. And if it's an IRA, that income can be subject to UBIT tax. And then your IRA has to file a tax return and pay tax on those earnings. And it's not a lot of fun to do. And so if you have a small business, even if it's a side business, you might think about setting up a retirement plan for the business. You can even roll money from an IRA into your own company's retirement plan, and then go and do the same kind of investing with the same kind of checkbook access. And then you don't have those UBIT tax problems on that side of it.
But you would need to be a profitable company in order to make contributions to that.
That's right. Yeah.
Okay. All right. Can you name any other great investments that we can make at the last minute to get tax credits?
Ooh. Yeah, you and I were chatting a little bit earlier. I mean, oil and gas is one. Late in the year, I see a lot of people plunk money into oil and gas. Can be a great investment too. I mean, I've seen good rates of return on some of those, 10, 15% sometimes. The benefit of investing in real estate is there are what's called intangible drilling costs. And intangible drilling costs is kind of like, just loosely conceptually, somebody raises money like they would on a multifamily, but we're going to go drill oil and gas wells. Okay. And we might drill 5 or 10 of them. It depends on the fund, but all the money that goes into setting these things up or a lot of it at least is what they call intangible drilling costs. And they attribute those to the investors ratably based on however much you put into the deal. And usually it's somewhere in the realm of like 75 to 85% of what you invested in the fund is going to flow through on your K1 as intangible drilling costs. And you don't have to have material participation or be it's not real estate. So it's not rentals. You don't have to be a real estate professional, and you don't have to have material participation to treat that loss as a non-passive loss, which means it can offset any of your sources of income: wages, interest, dividends, capital gains, you name it. And so that's the draw. It's like if you're in Q4 and you're out of plays, and it's like, I got this big tax bill. Is there something I could put money into quickly before the end of the year that's going to lower my taxes, but also be, a potential good investment and produce cash flow? I'm going to get royalties out of that, et cetera. That's one that a lot of folks look to. Going back to the Robert Kiyosaki name, when I was a young staff, I used to prepare all of his tax returns, and he has a lot of them. He's think of all the different companies he has. It was a lot of fun, but I would see what he was doing, and he would do a lot of this kind of stuff.
Yeah. Okay. Rhea says that she's heard from a CPA that switching from passive to active investing, being, doing the check mark, will very likely increase her chances of getting audited regularly. Is that correct?
I would strongly disagree with that.
Yeah.
You always have some risk of being audited, and entrepreneurs in particular have a higher risk of being audited as compared to just a W-2 employee. That it comes with the territory. The trick is do it right. Okay, do it right, and then don't worry about losing sleep over whether you're going to be audited. Your odds of being audited are still somewhere in the realm of like 0.3%. Okay, it's very, very low likelihood that any of you get audited. And I work with dozens and dozens of real estate professionals where they mark that box, they take those losses. And in the last 13 years, I have had 0 of them be audited in regard to their real estate professional status. So if you legitimately qualify, go forward confidently, take the tax losses, work with a CPA to make sure you're documenting things appropriately. I would absolutely not let concern of audit stop anyone from using that designation.
Perfect. I totally agree with you. If you're an operator on a deal, so you're active in that regard, but you're also investing in that same deal as an LP, would your K1 be for active or passive income loss?
So if the question that you have to
probably
the sometimes
okay.
I like to do it that way. I think it's just clearer as far as how, if you want to look at allocations and you have hundreds of investors, I think it's clearer to show as 2 separate chunks. This is the LP chunk and this is the GP chunk. But really the question you have to ask at the investor level is, am I a real estate professional? Do I meet those criteria? Do I log my time? Do I spend more time on real estate than non-real estate? If the answer to that is yes, it doesn't matter that I have 2 pieces of that deal. I can treat both of them as active. In fact, that is the correct treatment of that situation. So the K1 doesn't say Bob Smith is active. The K1 just says that you're a GP or an LP, but you still have to apply the criteria for material participation and real estate professional to decide at the individual level how those things are going to be treated. Just because it says LP doesn't mean that you have to be passive. And just because it says GP doesn't mean that you are automatically active. I mean, how many GPs have you met with, Julianne, who really maybe didn't spend that much time on the deal? In fact, I've known some guys that were GPs just because they brought their own money to the deal and they knew that the GP piece was more valuable. So it's like, hey man, I'll bring 500,000 to this deal to kickstart it. You put me in the GP team. But after that, they're not out raising capital. They're not doing all the legwork. Are they materially participating? Not necessarily. So the box on the K1 is not the deciding factor. It's how much time do I actually spend on real estate? That's the question.
Yeah. Good point. All right, Sanjay has a question. He has two self-directed solo 401k accounts with his wife and his. Each account has multiple passive LP investments inside of them. What consideration would we need to look at to potentially convert those accounts to Roth, or is that even an option? Is there a Roth solo or
Yeah, you
Roth
can have
self-directed?
you can have a self-directed Roth IRA. Yeah.
Oh,
and
wow.
and and so sometimes the question is like, do I want to deliberately take a portion of what's in my traditional IRA, have it hit my tax return as income, because I'm banking on in the long run that's going to save me money because I'm going to keep growing the value of what's in there. I'd rather take a tax hit now while it's worth this much rather than
Yeah.
paying tax later when it's worth this much. Okay. And so people do that deliberately. One thing you might look at is, can you time that event with losses that are not in your IRA that could offset? Can you individually make some investments where there's some cost segregation benefits, for example, or oil and gas investing, something to that nature, where the individual has outside of the IRA some other losses, where when I do that conversion to Roth, that's income that's going to hit my tax return. Do I have some losses that can hit at the same time and kind of mitigate the tax impact that in the same tax year? The trickiest part about converting that kind of thing to Roth can be that when you do that, you have to tell you have to base the conversion on some kind of value. Well, what's the value of a property that you invested in that started a year ago? Is it
Mm,
is it the value of what I invested in the deal, or is it some other, like,
yeah.
are you going to force the fund to go out and get an appraisal done? They're probably not going to do it.
Yeah.
So I see a lot of those where they value that conversion at cost, basically at what the person invested, and
Yeah.
that's probably the best value that you have available at the time. um, but then you have to just again look at the question of what does that amount to on paper that's going to hit my income tax return as income. What's the effect of that going to be? What are my tax rates now? Do I have any offsets? And is that better for me in the longer run? You have to kind of do some analysis around that with your CPA. But I love that idea. If I think that it's going to save me in the longer run because I'm going to grow that to become something really significant, yeah, let's get it into a Roth, because in down the road you don't pay tax on all the growth.
Would you think about taking a Roth and changing it into a self-directed IRA? Would that be a good strategy, or would that be going?
It, it's
I
not
mean, because
really,
then
yeah.
you would be investing it on your own, where the Roth you're not investing it on your own. So you
You
could do
can't
a
go from Roth
Roth.
to traditional.
You can't go from
What was
Roth.
that, George?
You can't go from Roth to traditional. You could go from a Roth non-self-directed account to a self-directed Roth account, but you can't go from Roth to traditional.
Yeah, there's not a conversion where you take your Roth account and roll it into a traditional, and because
How
what
about
would have to.
sorry to interrupt, but going from a Roth to a self-directed IRA, you could do that.
You could go from a Roth IRA to a Roth self-directed account.
Okay, but you can't go from a Roth to a self-directed IRA.
No.
Not a
Okay.
self-directed
Where the self-directed IRA is a traditional, no. Because
Okay.
think about what happens
Okay.
to get money into a traditional IRA. You have to
Yeah.
take a tax deduction,
Yeah.
right? So if Bob Smith wants to put $8,000 into his IRA this year, great. He takes a deduction of $8,000. Well, if I have $100,000 in my Roth IRA, and in theory, if you could roll it into a self-directed, not Roth IRA, traditional IRA, well, you'd have to take a deduction of $100,000, and that's just not allowed to be done.
Yeah. Okay. That makes
Yeah, I
sense.
think,
That makes sense.
Julian, I think the question is slightly different. Can you take a self-directed Roth IRA and move it into solo 401k Roth?
Yes.
That,
Yeah,
And I think
yeah, that
the
wasn't the
answer,
question though. That
you
wasn't the
can't go
question.
from a
And those are
Roth
both
IRA.
Roths, so that works.
Yeah.
You can't go from
you
a Roth IRA to a Roth 401k, but you can go the other way. Roth IRA,
okay.
is the one account that you can't go from to another.
Okay.
The reason for that is because there's no RMDs with a Roth IRA.
Required minimum distributions. Yeah.
Yeah, required minimum distributions. There is still RMDs, required minimum distributions, with a Roth 401k. But you can self-direct any retirement account out there.
Yeah.
Okay. All right, let's take one more question. So Kenneth says, if I have a small apartment building, 8 units, and want operate what is this, Kenneth?
If I have a small apartment building, 8 units, 7 of them can run 7 of them as long-term rentals, 1 of them is a short-term. If I want to take advantage of all the losses for all the active stuff for the short term, do I have to roll that into a different LLC, or can I have this to one LLC with the long-term rentals and, sort of I wouldn't say commingle, but can I operate it like that?
Yeah, that's kind of a gray area, but I think you could do it, regardless of what LLC, I don't think you could put it into LLCs anyway, but I don't think you would need to. I think you would just have to allocate everything. You'd have to take the cost of the property and split it up and say, all right, well, 7/8 of it is a regular long-term rental, 1/8 of it is short-term rental, prorate all the income and expenses that way. And I think you could probably treat the 1/8 portion as a active business.
All right. This has been amazing, Jim. One of the best CPA tax strategy business conversations we've had here at Zoom at 8. I really appreciate it. If somebody wants to ask you a question that we didn't get to, or is looking for tax strategies, what would that look like to contact you? And what does it look like? Do you sit down with us for an hour? What do you require for that conversation? What would that look like?
Yeah, so we have conversations with lots and lots of people about their situation. We do a no cost introductory consultation. So you can reach out to me, or you can go on our website. I just dropped it in the chat. It's provisionwealth.com. You can go to our contact us page there and drop your info in there. Someone will reach out and schedule that introductory consultation with you. We'll spend some time. What you'll find working with ProVision and our team is that we're going to ask you lots of questions that are driving toward how can we add value to you. We don't want to work with you just to work with you. We want to work with you because you have needs and we can meet them. And we're going to identify those early on in that interview process. What are your businesses? Where are you going with your investment strategy? What are your tax pain points? Okay, we want to identify those things and figure out, okay, we know right off the top that there's 10 things that we can do for you tomorrow that are going to add value to you. We're going to make it so that your investment in our service is exactly that. It's an investment, and you're going to get a return on that investment.
I contacted Tom Wheelwright to work with ProVision, I think it was. And I was told it was going to be about $25,000 for the tax strategy. Is that kind of what everybody should be thinking about? What the cost to work with to get started? Does that include, in addition, getting your taxes done? Or is it just sitting down, doing your tax strategy? You could go somewhere else to get your taxes, but you're really our coach, and you're really moving all of the pieces around for us. How does that work?
So when someone starts out with ProVision, we are going to pair them up with what's called a tax reduction plan. And that's really that front end, like, let's get into it. How are you structured? What are your asset types? What deductions have you been using? What are we missing out on? Okay, really, what can we do better for you? Okay, what deductions can we add? Are we going to should we have different entities in the mix? We're going to look at your entity structure. We're going to talk about estate planning. We're going to talk about all those things. And it's pretty intensive. And it's over the course of several weeks when you first start with us. But the price point is maybe not necessarily the same from one person to the next. So we're going to look at your situation. Okay, Bob Smith, who has 3 rental properties in an LLC on the side and works a W-2 job, his price point might be quite a bit lower than, another gentleman who has 20 businesses and has 100 K1 investments and has, much more complexities involved. So, you quoted what I would say is a higher price point of someone that has a lot going on. But if your business situation is less complicated, we do have lower price points that we could get you in and get you started with. And that is purely the planning component. Okay. Purely the planning component. Tax returns are another story. We can do your tax returns, or if you really like your guy and you want to keep doing your tax returns with your guy, that can be the case too. But I'll tell you, most want to have us do their tax returns. By the time we go through that planning process with you, you're going to feel like we got your back. Okay. We are digging and we're finding ways to help you have a better outcome. Now, try and take that and bring it to your other guy and have him implement it on your tax returns. It's not going to work out very well. You're going to want us to do your taxes. And those are separate fees, but there too, the fee base is based on the complexity. If your tax returns are relatively simple, the fee is lower. If you have a lot going on, I have a client who we do his individual tax return every year, and he's got 70 rental properties. 70 single family homes. His tax return is a little bit more expensive than some other people. It's just a lot of stuff to put on his tax return. So it really depends. And so you have to spend the time kind of going through that in that initial consultation, and then you can get a better sense of it.
Yeah, it makes sense. And listen, if you're looking for strategies, you may have to pay to get educated, but you're going to save in the long run. So you have to invest in yourself, invest in your quality of life that you're looking to have. And that's why you need to have professionals like Jim Ross on your team. So, all right. So if you want to get a hold of Jim Ross, again, it's provisionwealth.com, james.ross, R-O-S-S, at provisionwealth.com. His phone number is 866-467-5809. That's how you get a hold of him. And tell him you saw him on Zoom at 8. It'll be very helpful so you can make the connection.
Absolutely.
Gosh, Jim, thank you so much. This was fantastic. I really appreciate it.
I had a good time. Thanks for having me on.
I'm glad.
I love seeing some of the familiar faces that I've seen before, and lots of new ones as well. And so thank you all for being a part of it.